If you are interested in how I analyze these companies and you want to learn more about precisely how I do what I do, I am starting to teach people how to do this now. It's not something that I ever really set out to do, but I've had so much interest from doing the YouTube show, from people wanting to learn how to do it, that I've put a course together. And it's quite an extensive course. It's taken me quite a long time to put together. It's not expensive, but the return you'll get from it, but by being able to analyze any company's financials that you want to look at and explain and understand exactly what you're looking at when you do so, it pays for itself in that respect, because you'll be able to find the right companies to invest in going forward. Obviously, I'm biased because I created it, but it is a fantastic course, and it will teach you everything you need to know to be able to go out there and do this yourself. If you're interested in getting involved in that, go to a website called thecleantrader.com. That's my website, thecleantrader.com. And go over to where it says course, and it'll give you some information. And if you like what you see, if you want to enroll, you can enroll straight away. If you want to email me or hit me up on anything to ask any questions about what might be involved in there, you can email me at chris@thecleantrader.com. Today we are going to take a look at a company called Smith+nephew Plc. Hey there guys, how's it going? Welcome to the FTSE Show, the show where we dissect FTSE stocks, looking at the financials to see whether or not they're a company I would personally want to invest in. I'm looking for companies that are going to rise in share price growth over the next 10 or 20 years or so. We've looked at quite a substantial amount of companies now, 42 companies that we've looked at on this show. Personally, I have looked at 341 companies so far this year, and reporting on that to my membership group that subscribe to my reports that I send out every week, along with my own portfolio performance, so you can see the rise and fall of my own personal fund, as well as my watch list, the 43 companies that I've identified as scoring fantastically high and performing well enough for me to be interested as an investor in that company. I also do pricing analysis, so I can say of those 43 companies, which of those are currently priced at price that I would recommend buying at. All that kind of stuff, and that all gets sent out in a weekly report. And we found 43 companies. So far, we have touched probably about 5 of those companies on this show. So we haven't got anywhere near all those companies. But this show is more about raising awareness of both levels, the great companies, but also the dog cigarette butt sort of companies, right? Today we're going to look at a really good company. I did promise last week that at least one of the episodes this week we would look at a fantastic company. Now, on Monday we looked at IAG, get it right. The airline company with fantastic opportunities in terms of price, but the financials didn't look quite good enough for me to be an investor. Today we're going to take a look at a company called Smith+nephew Plc. I really like this company. I really like the numbers, the financials. The price is nowhere near as attractive as what we were looking with IAG, but the underlying financials and the fundamentals underneath are very, very solid. So without any further delay, let's dive into those numbers. Okay, so we're taking a look at Smith+nephew Plc. EPIC code is SN. These guys are in the FTSE 100 in the healthcare, equipment and services sector. So we have quite substantial revenue growth over 2008 to 2019. We saw a little bit of a dip between 2008 and 2009. This is pretty common for many companies because this was the years of the banking crisis and the financial crisis of 2008, 2009, and it did hit companies and it did hit revenues, and it's happened across many, many companies. So this is something that I see very, very commonly. And then since then, what's interesting is that the recovery's been pretty damn strong. We've gone from 3.7 billion to 3.9 in 2010, then 4.2, around the same in 2012, up to 4.3 in 2013, then 4.6, where it stayed at 4.6 billion a year until 2016, so about 3 years in a row. Then up to 4.7, 4.9 in 2018, and then in 2019 we're up to 5.1 billion. So there's a couple of years there where it kind of stayed stagnant, didn't really move anywhere, didn't grow very far for a couple of years. But then the following year it kind of then started to go back up again, and we've gone all the way from about 3.7 billion to 5.1 in about 10-11 year time span. So some steady revenue growth, because whilst it doesn't seem like a big jump, we're talking about the difference of 1.2 billion pounds here. So that is quite substantial. Looking at the cost of sales have ever so slightly risen, but largely looking at cost of sales and therefore the gross profit, and in accordance to that, the gross margin, i.e. the slice of the pie that the company get to keep, we've pretty much seen it consistent across the board. 2008, 2009, we're looking at about 72-73%, but from 2010 onwards, this company have consistently delivered numbers where the gross margin has been at about 74% every single year. Yes, there are, there's a 75% year in there, there's a 73% year in there, but on average, over the last 10, 11, 12 years, this company have delivered growth in revenue and an underlying growth in the cost of sales, which has meant that the company has kept a 74% slice of the pie, slice of the revenue, and kept that, which is obviously therefore growing. That gross profit is growing because that 74% and what that represents is higher every year as the revenue is increasing. So the pie, if you will, is getting bigger and bigger and bigger. So that 74% slice itself is getting bigger as well. Looking at the expenses, we've got a very similar situation here. Consistency. Looking at 2008, we're sitting at 71%. Looking at 2019, we're looking at 71%. And yes, again, there have been years where it's fallen to 63. There have been years where it's risen to 75. But consistently over those 12, 13 years or so, we're looking at a consistently average score of about 70% expenses. So 70% of the gross profit being spent on expenses. So of this, we just run through that very quickly. Of the 74% slice of the pie that Smith+nephew are keeping of the revenue that comes in, 70% of that is being spent on expenses, which gives us 30% left to see what happens with that money. The R&D costs are coming in at about 7%. Historically, between 2008 and 2012, we were looking at about 5% every single year. Then we started to see it hit 7% from 2013 onwards, and it's pretty much where it stayed. It's just kind of fallen below 7% from 2014 to 2018, but stayed around that kind of late sixes numbers, and then we jumped back up to 7.7% in 2019. But these are numbers that we'd be more than happy with in terms of R&D costs. And then we come down to interest on debt. Again, we're looking at about 6-7% a year max. We're not seeing anything higher than that, and that's a figure that we're more than comfortable with as well. So then we come down to the profit. The profit, it looks very, very good. This is the story of Smith+nephew. Really is a company you can rely on to deliver, because the net earnings have stayed very consistent as well. Now, we've had a couple of years where we dipped below 10%. That was 2008 and 2015, where we fell to 9.9% and 9.5%. Those were sub 10% years, but every other year otherwise has been above 10%. So 2009, 13%. We saw 16%. We've got a 14% year there, another 13% year, a couple of 11% years. And then in 2019, we're looking at 12%. And we can highlight all this in the spreadsheet here, and we can say that we can look at the average score of the profit percentages. And over the last 12 years, this company has averaged 12.5% net earnings a year. So that's great. That's a very healthy margin. If we have a year where expenses spike up a bit, it's not going to cause them to have a losing year. They're making good profits. In 2019, of the 5.1 billion that came in, they kept 0.6 billion, or in other words, 600 million for shareholders in terms of shareholder profits, which is very, very healthy. So looking at the current ratio, that's really healthy. It's 2.1. So what that tells us is that the current liabilities, total current liabilities come into 1.5 billion, but the total current assets come to 3.2 billion. So double that. So the current assets double the current the current liabilities, which is great. I'm interested to see the cash on book. It's only 277 million, so they're not heavy on cash right now. We can look at the debt levels, and we're looking at the short-term debt of 72 million in 2019. We can see long-term debt here of just shy of 2 billion, which is going to take a company of the size of this company and their earnings power about 3 years to pay that off. So looking at the net earnings of 600 million a year, it'd take them about 3 years to pay off that debt. That's a debt level that I myself as an investor would be very comfortable with. I wouldn't have any issues with that. And that's they're borrowing within their means, if you will. Looking at the equity level, so this is the assets minus the liabilities equals the equity left in the company. We can see that's risen in 2008 from 1.7 billion. If we fast forward to 2013, it was at 4 billion. It didn't really move from there for quite some years. From 2012 all the way up to 2016, it kind of got stuck at about 4 billion, wasn't really growing. Then we jumped up from 4.6, 4.8, and then in 2019, the equity of the company sits at 5.1 billion. So really healthy equity growth there in the company, which is great to see. And then retained earnings, again, looks really solid. We're up at 4.8 billion in retained earnings, and that's grown from 1.9 billion in 2008. And every single year we can see here that we've definitely seen some growth, consistent growth. And if I highlight all the actual retained earnings growth, we're looking at an average growth rate of 9% a year. So the retained earnings are growing at 9% a year on average, which is great. This is also a company that buys back its own shares every year. We can see here in 2019 they bought 63 million worth of their own shares back from shareholders. I like that. It kind of increases the hold of the existing shareholders because there's less in circulation now. It also creates more demand for the shares, which can drive up share price. So that's a good thing for the existing shareholders that still hold the shares. So that's a good stuff. So overall, we've got a really solid company here. They're not the best company I've ever seen, but they are very, very healthy. It's a very, very healthy business here. So with that, let's go and take a look at the chart very quickly. Okay, so going all the way back to 2008 here, we can see the price sitting at £7 a share. We saw it dip down in 2009. That was off the back of those relatively poorer results that came in following the financial crisis, and we saw the share price fall to £4.60 or so. And then from there, it's just been plain sailing all the way up. And this is the kind of chart we would expect to see from a company that's producing those sorts of numbers, that consistent 12-15% a year net earnings, growing equity, growing retained earnings. Everything's looking good. All the trends are going in the right direction. A couple of years of stagnant growth where not much was really happening in terms of the equity, but this is a company that has just moved and grown and grown and got bigger and better over those years. And then we saw it reach to a peak of about £20 a share before 2020 kicked in, and the events of 2020, which has caused the share price to fall to lows of about £10 a share, which is, for me, I would see that as a fantastic opportunity to get in, half price. And had you done so, you would have done very well, because the shares didn't spend very long down there. And in fact, a few months later, we're up at £16 a share now. And that's a really good chart. These are the sorts of charts I like. This is an investor's dream, really. And even after the events of 2020, we're still looking very, very healthy as a company. And I would expect that would be the case, bear in mind the industry this company are in and the kind of work that they do and the results that they have been getting from their financials. So let's go and take a look and see how they did on the leaderboard. Okay then guys, so really positive numbers, a positive looking chart, everything's looking really solid there. Let's get into some a little bit more kind of data on the price. Price is currently £16 a share. The earnings per share is about 68 pence per share. That's only a 4.2% return. So that's going to indicate to me that the price is pretty much at its upper limit of what I'd be prepared to pay. To be fair, the 4.2% puts me off a little bit. And I would argue that the share price right now for Smith & Nephew is a little bit too high for what you're getting. We can also judge that based on the current assets of the company, which the equity of the company, which sits at about £5.82 a share. That would indicate that £16 is okay. It's not a bad price. It's sitting at the kind of a fair value range right now. So for me to place this company in a kind of fair price, I'd be looking at about £10 to £14. I think would be a good price for Smith & Nephew. A great price would be about £8 a share. Obviously, we're miles away from that. The likelihood of us falling from 16 to 8, it would require quite a significant correction for us to be able to pick up that opportunity. If that correction happened tomorrow, I would be buying this company at £8 a share. I would probably buy more at sort of 9, 10, maybe £11 a share. At £16 a share, what we've done here is we've got a great company that's probably going to score relatively well on this leaderboard, but right now is not the time for me. Right now, I feel the price is just a little bit too high for me. I might be missing a massive opportunity. Who knows? This could go up to £50 a share over the next 10 years. They could well do that with the caliber of this company. But when it comes down to pricing, they're just a little bit too expensive for me, and maybe I'll miss out on that. Who knows? Dividend yields 1.8%. So this is not a dividend company. I don't really look for dividend companies anyway. The dividends that I get from the companies I buy are just an added on bonus. I reinvest those dividends for future compounded growth. So right now, I would argue that Smith & Nephew's a little bit overpriced for my liking, but I could be wrong. Who knows? Let's get them up on the board anyway, see how they do. Okay, so the epic code is SN dot. I hate those epic codes with the dot on them. It's really annoying. I don't know why. Who knows? A decent score here. A very decent score. I've kind of messed the 6 up a little bit, but hey ho, who cares? Smith & Nephew score a very respectable and very well deserved 76 points. So they're not quite the 100-point company that maybe some of you were hoping for, but 76 points is still very respectable. Still a company that you should really pay attention to, I believe. Let's get them up on the board. Okay, so 8th place on the board. I think that's absolutely fair. They're not the runaway, fantastic, promising, huge odds of growth sort of company, but they are still very solid and one of my favourites for sure. And they deserve that place on the board, I would say. When we look across the FTSE 100, the 250, the small cap, the fledgling, and now the AIM markets, we see a lot of essentially dog turd companies, very poor companies that are scoring nowhere near the likes of Smith & Nephew in terms of financial results, in terms of profit margins, in terms of growth prospects. And Smith & Nephew do tick pretty much all of those boxes. And really what separates those kind of top 8 companies is just the actual performance of those numbers. They're all great companies in their own rights. They're all doing very, very well. They're growing. They've got good margins. Just some are slightly better than others, and some show better trends than others. And Smith & Nephew's trends just weren't quite as strong as some of these other companies. We've lost AA off the board. I'm pretty sure, I say pretty sure, I feel 80% sure that AA were the first company we looked at on episode number 1. There's no nostalgia at all about that. So thank you very much for watching, guys. I'll see you guys next week. Thank you for watching.